For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. In the last SoFi video, I talked positively about the company, but this video will be much more bearish so that you can understand the pros and the cons of this company. SoFi Technologies has been on a remarkable upward trajectory, with its stock price surging by over 120% in just the past 3 months. This rally has been driven by several catalysts, including a strong market reaction to Donald Trump's election victory and a stellar financial performance during Q3. The company's recent success has caught the attention of analysts, with Bank of America analyst Mihir Bhatia characterizing SoFi's execution as solid. He points to the student loan refinancing business as a potential beneficiary of less favorable loan forgiveness policies under the Trump administration, which could increase demand for SoFi's services in this area. Despite these positive developments, Bhatia has raised concerns about the stock's valuation following its recent rally. He believes that SoFi is now priced for perfection, meaning that its current valuation may have outpaced its fundamental strengths. This suggests that the stock's ability to continue its upward momentum may be limited unless the company delivers exceptional results or exceeds growth expectations. In Q4 of 2023, SoFi provided investors with a preliminary guide for its projected performance in 2026. The company forecasted an earnings per share range of 55 cents to 80 cents and predicted annual earnings growth of 20 to 25% in the years ahead. At first glance, this ambitious growth outlook appears to be a significant positive. It even hints at a potential upside when compared to the current 2026 consensus estimate of 48 cents per share, with Bank of America's internal estimate slightly higher at 52 cents per share. However, for a company to achieve such rapid growth over several years, it must consistently deliver exceptional results across all segments of its business. Additionally, he notes that SoFi's valuation is already at a premium, with the company trading at 32 times its projected earnings per share for 2026. While higher growth rates can justify a premium valuation, SoFi's valuation is currently 3 times higher than that of its peers in the consumer finance sector. This raises questions about whether the stock has room for further valuation expansion. Another key area of concern for investors relates to SoFi's fair value marks and hedging activities. In Q3, the company reported hedge-related losses totaling $273 million. These losses included a spread impact of approximately $150 million. Such significant losses have sparked concerns that further rate cuts and increased market volatility could exacerbate these challenges in the future. Higher fair value adjustments will also need to be amortized over time, which could place additional pressure on SoFi's non-interest income. In addition to financial concerns, SoFi has faced challenges in its technology segment. Growth projections for this division were recently revised downward due to delays in closing deals and partnerships. While the company has emphasized that none of these deals have been lost, the timeline for realizing revenue acceleration has become less clear. This lack of visibility adds another layer of uncertainty to SoFi's growth outlook. He now views the stock's current valuation as less favorable when assessing the balance between risk and reward. As a result, he has downgraded his rating on SoFi from neutral to underperform, which corresponds to a sell rating. Bhatia has also set a price target of $12, which implies a potential 23% decline in the stock's value over the next year. The sentiment surrounding SoFi is not uniformly negative, but caution dominates the broader analyst consensus. 2 other analysts have joined Bhatia in adopting a bearish outlook on the stock. Meanwhile, 5 analysts maintain a buy rating, and 6 have issued a hold recommendation. The consensus price target of $11.46 suggests that the stock could face a correction of approximately 26% over the next 12 months. SoFi Technologies stock had been on an impressive upward trajectory for several months, defying the odds and impressing investors with its rapid growth. However, in recent times, the stock has started to show signs of a decline, leading to increased skepticism among analysts about the company's ability to maintain its elevated valuation. Investment bank analysts, in particular, are questioning whether SoFi's underlying business has scaled quickly enough to support its high stock price. Is SoFi Technologies still a strong stock to invest in, or has it already risen too far? In order to address this question, let's take a deep dive into the factors that have fueled SoFi's rapid growth this year and examine the reasons why Wall Street has become more cautious about the stock. A major contributor to SoFi's recent success is its aggressive strategy of expanding its member base by issuing large volumes of unsecured personal loans. The company's lending division has been a key driver of its overall growth, and it has managed to attract a significant number of borrowers. At the same time, investors had previously been concerned that SoFi was taking on a risky portfolio of loans, with fears that it might be underwriting bad loans. These concerns began to subside when the company reported a decrease in delinquencies lasting more than 90 days for 2 consecutive quarters. With the Federal Reserve having already lowered interest rates by 0.75% in 2024 and another 0.25% rate cut expected on December 18, 2024, the lower borrowing costs could stimulate demand for personal loans. While lower interest rates can sometimes shrink profit margins, the increased volume of loans being originated more than offsets this impact, allowing SoFi to benefit from both higher revenue and a growing customer base. In fact, the company's lending segment delivered record revenue in the third quarter of the year, with a contribution profit that increased by 17% year over year. These impressive figures reflect the success of SoFi's strategy in the personal loan space and underline the company's ability to maintain robust growth even in a more challenging macroeconomic environment. Lending is not the only part of SoFi's business that has been experiencing rapid growth. In addition to personal loans, many borrowers are also taking advantage of SoFi's broader suite of financial services, including checking, savings, and retirement accounts. As a result, SoFi has been able to diversify its revenue streams and grow its overall business. At the beginning of 2023, SoFi's financial services segment was still struggling to generate positive contributions, and the company was losing money in this area. However, since then, the financial services segment has shown remarkable improvement, with a rapidly growing contribution profit that reached $99.8 million in the third quarter. Another key advantage that SoFi Technologies holds over its competitors is its ownership of the Galileo financial technology platform. Rather than relying on third-party software vendors to issue cards and process payments, SoFi has invested in building its own technology infrastructure. This has given the company greater control over its operations and allowed it to automate many of its financial services tasks. Galileo is used by a range of financial institutions, including well-known companies like Toast, to streamline and automate various financial tasks. In the third quarter of 2024, the contribution profits from SoFi's tech platform segment reached a record $33 million. Further demonstrating the value of this strategic asset to the company's overall growth. The company has demonstrated strong cost management, which has helped it generate impressive profits in the face of rising investments in new initiatives. Management has projected that SoFi's net income, based on generally accepted accounting principles, will reach $205 million at the midpoint of its guidance range. While this represents a slight decline from the previous quarter, it is still a massive improvement compared to the significant losses SoFi was reporting just a year ago. This turnaround in profitability is a testament to the company's ability to adapt and execute its growth strategy effectively. To summarize, SoFi Technologies has demonstrated significant growth and has benefited from favorable market conditions in recent months. However, concerns about its valuation, execution risks, and challenges in its technology segment suggest that the stock may face headwinds in the near future. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.